Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Vishnu Chemicals Limited. So Vishnu Chemicals is in the business of manufacturing, marketing, and export of chromium chemicals and barium compounds across the world. It is the largest integrated manufacturer of chromium and barium chemicals in India. Now the company has access to 50 plus export destinations with 10 plus end user applications and have got 1,000 plus diversified and inclusive workforce. Now, the company is built on the values of integrity, excellence, collaboration, and innovation. Some of their product mix includes sodium dichromate, basic chrome sulphate, chromic acid, etc. And their end user application is also mentioned where they are used in multiple industries ranging from automobiles to paper, detergents, and as well as artificial sweeteners and pharmaceuticals. Not just that, they are also present in water treatment, powder coating, paints, ceramics and tiles, and other end user applications. So here the company mentions how chromium chemicals touches our lives, which often go unnoticed. So chromium is present in leather sofas, ceramic tiles, green bottles, refrigerator coils, detergents, as well as leather headboards, chrome lamps, shower heads, tower rack, and whatnot. Now the company has got a multi-locational manufacturing facilities. They have got one plant in Bhilai, another one in Hyderabad, and two more in Vizag and Andhra Pradesh respectively. So the company has demonstrated consistent margin profiles. However, the margins have taken a dip since last year. This happened due to a dip in the standalone margins, and the reason will be discussed as follows. The company has a balanced sales mix of 54% domestic and 46% export sales in FY25, which demonstrates the company's ability to be agile. They have got margins in standalone business, which were impacted due to elevated raw material cost, freight, and softness in export markets due to current macroeconomic environment. Now, their shipping cost has declined last quarter as compared to Q3 of FY25, which is good. And they're improving the logistics scenario in assisting in gradual. And they have shown improvement. And the capex is on diversify into new chemistry. In FY20, they have set up Vishnu Strontium Private Limited. Regarding the South Africa expansion, so statutory approvals and clearances are in process, and they are optimistic about commencing operations in September, October this year. So, coming to the industry overview, India is the sixth largest chemical producer globally and contributes to 7% to its GDP. And the Indian chemicals market is valued at USD $220 billion in 2024 and is expected to touch $300 billion by 2030 and $1 trillion by 2040. And India ranks 14th in exports and 8th in imports globally in the chemical trade. India's strategic location list enhances feedstock access, logistics efficiency. Not only that, the specialty chemical segment is projected from $64.5 billion in 2024 to $92.6 billion by 2033, with a CAGR of 3.8%. Also, India's inorganic chemicals market is set to grow at a much higher pace of 5.8% CAGR, $74 billion in 2033. Barium segment outperformed due to coming to the con call highlights. So their barium segment outperformed due to backward integration, thus minerals and strong demand from the paint and ceramic. So Ramdas Minerals is basically the latest acquisitions, which required a few years down the line. And barium volumes grew 30%, while chromium volumes grew 9% in FY25. And chromium segment margins were temporarily impacted due to higher chrome and freight costs. The barium capacity utilization rose to 77% in Q4, and the company is targeting around 80% in FY26. And the strontium carbonate project will start commercial production in June 2025, with revenue expected from half two of FY26. So the revenue from strontium is expected at 250 to 300 crores over the next 2 years, with strong domestic and export demand. And chrome ore mine, which they acquired in South Africa, is under review. And operations are expected to begin by September to October in 2020. And the company targets 15 to 20% of top line growth in FY26, driven by all verticals: barium, chromium, and strontium. Also, FY25's capex stood at 88 crores, and additional 52 crores was used to acquire. And Barium segment has also low cost advantage in global competitiveness, and the management even feels that they are giving a good competition to even China in the global markets. Coming to the bull case scenario, continued backward integration and capacity ramp up unlocks margin expansion and supply chain resilience for the company. Strontium carbonate business can scale rapidly with strong demand and limited competition. Not only that, chrome ore mining is expected to become operational in FY25, reducing their input costs and boosting their EBITDA. Also, domestic demand and export tailwinds can fuel consistent double-digit growth, and their asset-light multi-site operations support scalability, and hence there are high chances of ROCE improvement in the upcoming years for the company. Coming to the bear case scenario, so any kind of delay or execution issues in chrome mine approvals can impact expected savings and margins. And export demand recovery might lag amid the current geopolitical or freight disruptions. Also, raw material inflation or supply chain shocks can strain profitability despite the company's diversification. And global slowdown or regulatory headwinds can also curtail volume and price growth. So coming to the 20 factor scorecard, the company raised 200 crores in QIP in 2023, all of which was used to repay borrowings. 75 crore was used to repay the company's own borrowings, and another 75 crores to repay the borrowings of subsidiary VPPL. They raised 46 crore for general corporate purposes. So I give a zero since it was entirely to pay off debt. Also, regarding promoter track record, they've got a very good management team of years of experience, and Cherukuri family holds around 69% of the company. So I gave them a year. Related party transactions are not very high, but they're worth to be noted. There have been purchase and sales transactions with subsidiaries. And there is 28 crores worth of transport charges which were paid to companies where promoters have interest. So this is something that's very important, that the breakup 8 crore which they paid in transportation charges. So the company has repaid unsecured loans which they had taken from promoters in earlier years. So it was worth 30 crores. So the interest rate at which the promoters gave the loan is also important to be looked into. So I gave 3 here. Regarding board composition and independence, the number of directors are 7, with 4 independent directors and 3 family members. So there is 57% independent director representation and 43% family representation. So it's decent. So I give them a 5 here. CEO and KMP salary is quite less, 0.13% of sales. So that's good. So I give them here. Key person resignations are not paid yet. The last resignation was of secretary and compliance officer, that too in 2022. And the previous resignation was one of an independent director in 2019 and another of a CFO in 2017. So I gave them a 5. Regarding auditor resignation, auditor is serving their second term and they have their tenure till 2026. Also, auditor opinion has been modified over the year, and very good ratings from CARE, and they've shown improvement in the past 3 years. It's also a good sign. So I give them a 5 year. Regarding regulatory or legal issue, so nothing could be found against the company. So I gave them a 5 year. Regarding investor communication and disclosure, so the company discloses everything starting from presentation, press releases to con call and results. So I give them a 5 year. Coming to financial health, top 10 customers contribute less than 40% of their revenue, and sales to top 10 dealers or distributors are around 34% of total sales. They have got presence in 50 plus countries and they supply majorly in markets including Brazil, USA, Mexico, South Korea, Italy, Germany, Australia, Bangladesh, Argentina, and Egypt, among others. Also, they have got repeated orders from long standing and reputed clientele including Solara Active Pharma Sciences Limited, IOL Chemicals and Pharmaceuticals Limited, and Montana Química Limited, among others. So I get them a 5 year since they are quite diversified. Regarding CFO by EBITDA, it does not look quite good. Over the years, it has been declining severely. However, since last year, it showed some improvement, but it's still low because of high inventory and high receivables. So I give them a 3 year. Revenue growth versus receivables have been quite stagnant. We can say revenue is growing at a decent pace. However, receivable has been growing at a much higher pace than that. So as we can see in March 2023, it was just 30% receivables by revenue, which went up to 20% in FY25. So I give them a 3 year. The inventory trends are as follows. Inventory days are at 134, which is quite high. And inventory growth has been also significant. And inventory as a percentage of revenue has been increasing consistently over the years. So all of this might lead to stagnation of inventory. So I gave them a 3 year. Regarding the cash conversion cycle, it's quite high as compared to others. So I give them a 3 year. Its cash conversion cycle is around 105 owing to high inventory days. Regarding capex by revenue, so capex is 6% of revenue this year, and the company has been consistently doing capex over the past few years. The asset turnover is 1, which is decent, and fixed asset turnover is 2, which is good. Return on invested capital is also decent, however, it has been declining over the past 1 or 2 years. Still, I give them a 5 year. Regarding debt and interest coverage, debt to equity is 0.4, which is good. Interest coverage is also 5.4, which is decent. So I give them a 5 year. Quick ratio and current ratio is also good. However, there has been a high difference between quick and current ratio on account of high inventory which the company is holding. So I give them a 5 year. Return on equity and return on capital employed is also decent. However, it has been declining over the years, but they are still good. And return on asset has also been decent or average. We can say it's around 8%. So I give them a 5 year on account of high ROCE and ROE. Regarding growth consistency, the company's growth is quite consistent over the past few years. In March 2024, they took a bit dip. However, the company has recovered significantly since then. So has been with the PAT. The PAT is growing at a much higher rate as compared to revenue. So that's a good sign. The company is improving margins. So I give them a 5 year. Now coming to the total score in section 1, governance and promoter behavior, the company scored 43 out of 50, and in financial health, the company scored 42 out of 50, making their final score to 85 out of 100. Now coming to the valuation analysis.
Why did the 24 there was a revenue dip? Any idea?
No, sir, I did not deep dive into that, but maybe it was because of export slowdown, because the management has been talking about it in the con call.
Very interesting company. I would deep dive a bit more into understanding their chemistry and the application and end user industries in a bit more detail. The stock has been a multi-bagger role for the last 5 years. Will it is something to be mindful, or they have the margins growths have
Sir, your
declined a
voice is
bit?
cracking.
It's better now.
Yeah.
Okay. The should I start from the beginning?
No, it just cracked a bit right now. It was still audible.
Okay. So the gross margins we have to be mindful of, because the input raw material cost of volatility will always affect their gross margin. However, the company has maintained to grow its revenue at a very decent rate, and there are few upcoming capacity that are coming
FY26. Yes, after a bit of consolidation, the growth seems to be coming back. So to be conservative, let's just take worst case, and based on the estimates, the current PE is around 30. But if we give a PE of 20, the price target comes to 380. The current price is 575. That also has to do with a bit with the margin and everything. If you give a margin of 16, then it is 438. But however, sure what the management has guided for the growth, but on a conservative basis, giving a PE of 22 and 20, the price is 575 for the best, 557 for the best case, and 438 for the worst case. The stock is trading at 575. Maybe it is expecting some going better, much higher growth in the future could be one of the reasons. So look, that the management has done capex over the last couple of years, so these should reflect in the numbers very soon. If you're taking a slightly longer perspective, okay, free cash flow is just 2. So let's see, I think cash flow is 90 and if it is 127, so the conversion is a bit low. So let's take operating cash flow for on a basis. The discount rate around 20 because it's a bit more larger company, and terminal growth rate of 3, and a time period of 5 years, and trailing multiple of 20. The implied growth rate has to be 33% for us to realize the discount rate of realized return of 20. So not would they be able to achieve it? Looks likely, given the cycle has been in consolidation for last 5 years and a new capex coming on stream. So good stock to track and research a bit more deeper into and buy. Overall score also looks pretty decent according to our framework. Any final thoughts?
Nothing much, only it's important for us to better understand what are the end user application and what is the importance of chromium, barium, and strontium in global trade as well as industry demand cycles and all that to better understand and better value the stock in a better way. So that would be important in the upcoming term to analyze.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.